Welcome to the Kent Lapp Podcast.
What do you most commonly recommend for people in terms of then investing? Is it stocks? Is it mutual funds? Is it ETFs? I'd love to hear you kind of talk through that. And if there's even some particular companies right now that you're paying extra attention to or whatever, I'd love to hear that too.
Yeah, no individual stocks. Think about it when you're buying an individual stock, you're letting that company use your money. If you look at you ask that company, hey, you want to pay me more to use my money? Well, no, they don't want to pay you any more than they have to. Mm-hmm. So if I own one single stock and I compare it to all companies that are like risk of that company, maybe there are another 100 companies out there that are the same risk level as that particular company, or maybe even some maybe even the same industry. That entire group of stocks, the expected return is the same as that single company because they don't want to pay any more to use our money. So think of the stock market as a system, like the ocean is a system. Water goes up and goes down and goes up and down. Now, in that system, in any given day, what's the likelihood one boat is going to sink? Probably pretty good. Mm-hmm. Something seriously could happen to one boat and it sinks. What are the likelihood of all of them sinking? Pretty slim to none. Mm-hmm. So there's a systematic risk in that markets go up and down, but there's a non-systematic risk that something happens to just one of those boats, and you don't want to take that. You don't want to take risk that you're not paid to take. The expected return of a single company is no higher than the area of the market. Why would I buy a single company? Because I believe, goes all the way back to the beginning of our conversation, that it is selling for less than what it's really worth. I believe that markets are inefficient, that it's selling for this, and it's really worth this because I know more about this company, and I think I've got an inside track on this company, and it's really worth more. So that's the only reason I would invest in an individual stock, is because I think it's mispriced. But there's a Nobel Prize awarded to show, no, even the pros can't do it. Mm-hmm. You got somewhere than 90 to 96% of professional fund managers cannot get higher returns than what the market did over the past 15 years. If they can't do it, our likelihood of doing it is pretty doggone slim.
Yep. So then what do you recommend? Mutual funds?
Mutual funds and ETFs, both of them. Okay. ETFs can work in some asset classes. Mutual funds would be the only good choice in other asset categories because of exposure. What areas of the market I can get. There are some areas of the market I want to be in, like international small value. I don't have an ETF that actually captures that well. Mm-hmm. In U.S. small companies as well, some areas of U.S. small companies. So yeah, both of those, because now I'm spreading that risk between thousands and thousands of companies.
Yes. And some people, do you find, though, want the adrenaline kick or the rush, or they want, I don't know, I hate to say distraction, but they want to be checking in on their stocks, right?
Sure.
Like that's the last thing I want to be doing.
Sure.
But some people actually like that part of it. And so I guess if they want to, so then what would you say? Okay, well then let's look at your income. Let's see how much you can be investing. Let's get that going into ETFs and mutual funds on a consistent basis. And sure, if you want to tamper with a few $100 over here and pay attention to it.
If that's your hobby.
Then go ahead.
Yeah, it's your hobby. Okay. Just like going to a casino might be somebody's hobby. It wouldn't be my hobby.
Sure.
I don't look at it and go, no. If the pros can't do it, if the highest paid, there's a pension study of 91 pensions, not one of them increased returns, not one of them, as a result of stock picking or market timing. Not one of them. It just
seems like such undervalued information. You know what I mean? Everyone's trying to beat what you're just saying.
Yeah. And that's the industry. You'll see that it's well up in the high 80% range of investments are managed on a market's fail or market inefficiency philosophy. So it is very pervasive. Why is it so pervasive? Because of ego. I really believe I can do this. Mm-hmm. I know these guys can't do it out there. I just really think I can do it. Or because, there's these biases. Mm-hmm. Past performance. I know it's no indication of future performance, but the stock market's going up. No, it went up. Mm-hmm. I don't know what it's going to do tomorrow. Or tomorrow's, I don't know what it's going to do over the next week. I really don't know. I can't tell you what it's going to do, but I can tell you all day long what it did in the past. So in our emotions, greed takes over. Fear. Sometimes I get scared and I hear something bad in the media and I pull all my money out of the stock market. So it gets down to the psychology, really, again.
Yep. Stocks are down in the last, was it last week? is that partly because of the chatter going around about Biden's changing the capital gains tax, or why are stocks down last week, or do you pay zero attention to that?
They were down the first part of the week, but they were up in the second part of the week.
Okay.
So there's new in some areas. And I always, when somebody say stocks, I say what area. You
Sure.
had actually small companies are up and large companies are down. The Dow's down and you have small companies up. That's that dissimilar price movement. So it's all different areas in the market.
Yeah.
And it's people do that all the time.
Yeah, that makes sense. Now, can you clarify? I think you said if you look back at any 30-year period,
yes,
since say the
1926,
since 26, the Great Depression.
Yep, prior.
Any 30-year period since, stocks have returned an average of 10%?
This is large U.S. stocks. So if you look at large U.S. stocks, 1926 to 1955, that 30-year period, about 10.2%. 1927 to 56, it's like, just around 10%. And 1928 to, and you look at every single rolling 30-year period, even, and you look at that period of time I just named, 26 to 55. That includes the Great Depression, World War II, Korean War, some really bad stuff.
Yeah.
And the return was still 10%. Now, for small companies, it's around 12. If I look for large value companies, about 11.5, 12. If I look at small value, it's actually 14. It's actually higher. International, this blows people's minds. Go all the way back in history, and large U.S. stocks and large international stocks back to, we got large British companies back in the 1950s, we got data, 10%, right in the same exact ballpark. Small international, small U.S., about the same return. So we find it's what we call out of sample. It doesn't just happen in the U.S. It happens in Great Britain. It happens in Germany. So that's why Fama won the Nobel, is because you had robust data and it was out of sample. It happened everywhere. And he said he's on to something here.
So if I said to you, look, man, I have X amount of money and I'm going to put it into ETFs or mutual funds or a combination of the two, put it in the market in a pretty diversified manner. And I'm going to do that because I expect that 30 years, and I'm not going to touch it, but 30 years from now, I expect that to have an averaged annual return for me of 10% per year. And that's my expectation. You would say, yeah, sounds about right.
Yeah. It probably a little bit higher if you're more diversified. Remember, I was just naming large U.S. stocks, which is the lowest performing of all those asset categories that I named. Why? Why are large U.S. companies, where most Americans put all their money, unbeknownst to them? You buy a total stock market fund, you think, I got the total stock market. No, it's capitalization weighted. It's weighted based on the size of the companies, and most of your money is in big companies again. So people think that they're really diversified. Now, if I look at that area, say, well, why is that area lower returning than everything else? Because those companies are the biggest companies. They're the least risky. They're the best known. Everybody likes them. And guess what? Because of that, they don't have to pay as much to use your money.
Yeah. Yep. That makes sense. Are you being, with ETFs or mutual funds, it's not so much. I was just kind of curious if you like stocks that pay dividends, but that's not so much a thing with mutual funds and ETFs, is it?
Those would be value companies. Value companies typically pay more dividends. Why? Because their earnings are higher compared to their share price, the price of the companies. So the dividend is bigger. So technically, historically, but do you want to put all your money in nothing but distressed companies? Probably not a good idea, A. B, it also goes against what Solomon said, put your money in the 7 to 8 places.
For some reason, I don't remember that in Ecclesiastes. I love that book.
Me too,
It's such a great book.
11-2, go read it.
Okay.